With the level of the levies we're seeing in the U.S. and China placing on each other, a 10% base rate in place, sectoral tariffs to contend with as well. What kind of growth hit are we talking about already, even without the highest of the highest rates kicking in for all countries?
Well, we are seeing already still seeing people buying ahead of tariffs. Those who can will buy ahead of tariffs. Others are hunkering down. And so this is sort of that mixed economic message that we're hearing from the soft versus the hard signals. And I think that's important. But the other issue is, as we look at this going forward, it doesn't take much of an extension of this to sadly get us into the pull forward on demand and the sort of stacking up of inventories. There's been a lot of that going on as well. That sets us up for weaker growth going forward, and we actually have the economy going into a shallow recession later this spring and into the summer, and the Fed not being able to cut its interest rates in terms of short-term interest rates until the end of the year.
Well, if we're considering an outlook in which we could see a growth downturn in that short period of time, Diane, typically you would think investors might be seeking haven in an asset like U.S. Treasuries. And instead, we just saw the 10-year Treasury yield have the biggest weekly gain, as in yields going up, price of bond going down, since 2001. What is the bond market reflecting here?
It really is reflecting that sort of concern that we are no longer the safe haven. This is something we've been for a very long time, the reserve currency of the world. There is no easy replacement at this point in time, but clearly the idea that we'd raise tariffs and the dollar would depreciate instead of appreciate, and in a world with such uncertainty that the bond yields would rise instead of fall, that's clearly created some is something to worry about, very much worry about. And it suggests a return to the old term bond vigilantes. And that is something that clearly has spooked the administration as well. We heard that echoed earlier this week, and I think that's important too.
Well, will it spook the Federal Reserve? We obviously had some suggestions by Susan Collins today, Diane, that the Fed would intervene if it deemed it necessary. But how high realistically is that bar?
Well, there's one thing about intervening. There's intervening to stabilize the Treasury bond market if it seizes up. That's not necessarily. There could be something very similar to what we saw in the UK in 2022 when they lost a prime minister. That was an intervention, even though the central bank was still tightening. It was an intervention that did not actually ease financial conditions a lot. And I think that's where you see the Fed stepping in. Is they have to worry about how well our market's functioning. That is one of the things they can do, is help with market functioning. But on the other side of it, actually cutting rates, that's a different equation. And so I think the interventions, you have to be very careful about what the Fed is thinking about and how they'll delineate those. And I would suspect that they would be looking at ways to delineate, much like they did when we saw as they began to raise rates in 2022 and we had a banking crisis.
Well, I take your point on the different kind of tools the Fed would be wielding here, that it's not just about the interest rate mechanism, but on the idea of rate cuts, considering the inflation data we got today and yesterday across CPI and PPI, which of course feeds into PCE, the preferred inflation metric. Would that not be a suggestion that the Fed actually has to be less worried about inflation and can pay more attention to the other side of the dual mandate? Or because that data is backward looking before a lot of these tariffs kicked in, does that effectively have no influence on the Fed at this point?
Well, sadly, I think the latter is true. If this was another world, this would be a time when the Fed would be doing its happy dance and saying, hey, we won. We are defeating inflation effectively, and we can continue cutting. That is not the case today. Also, the PPI does not include some of the tariffs that have already gone into effect. PPI does not include tariffs into their numbers. But as Mike pointed out, Mike McKee earlier, that steel prices had been front-running. They've been stockpiling ahead, and we saw steel prices pick up, and that showed up in the PPI today. That's going to go through into other manufacturing costs, and we know those prices are coming down the pike. What we heard Jay Powell say on April 4th and what we've heard Neil Kashkari echo today is that, there is a risk of both higher inflation and weaker growth. If push comes to shove and you have higher inflation that you're unsure about it sticking, when the embers of inflation are still smoldering, you're not going to cut rates.